Hello and welcome to the first ever Downtown Pittsburgh Investors Business Daily Meetup presentation. This is the November 2015 presentation, which is the same month the group was founded. So thank you all for being some of the first members to join the group. And I've been pretty pleasantly surprised with the number of members we have already. My name is Eric Rossi. I'm a co-organizer of this meetup group. And on the first slide here, you'll see a link to the meetup group in case you are finding this video on YouTube, which is where these videos are going to be posted. If you're just finding the video through YouTube, then if you're interested in joining the meetup group, you can follow that link and request to join the group. There are going to be some files attached in Meetup, things like cheat sheets and spreadsheets that are not available through the YouTube channel. So that's the advantage of joining the meetup group. Introduction to the group. The mission statement is to educate individual investors about the CanSlim investing strategy. And this really means identifying the best educational material from books and articles, webinars, videos, etc. There's tons of information out there about even about this particular investing strategy. And there's all these books, there's articles online on investors.com, there's videos that get posted every day to IBD TV, there's webinars that are hosted by IBD and by MarketSmith. So each month I go through all this stuff and pull out the most relevant and the best tips that I come across. So that's really what I'm sharing here with the members of this meetup group, with the goal being that you don't have to sift through all those videos and articles just to pick out a handful of good tips to take away each month. Because every month, if we can just take away a handful of good tips and good educational notes, then over time that'll really build up and increase our investing success. And a disclaimer here, this presentation is educational in nature, and this should not be construed as recommendations to buy or sell any stocks. Investing in stocks does carry risk, and you can lose your capital if you're not careful, lose your principal. I'm a non-professional investor, and I volunteer my time to run the meetup group. I'm not paid by IBD or anyone else to do this. And Investors Business Daily, IBD, and CanSlim are registered trademarks of Investors Business Daily, Inc., and Meetup is a registered trademark of Meetup, Inc. So if you're just getting started or you're not familiar with all the CanSlim books that are out there, these are the 5 main books about CanSlim investing. And 3 of these were written by Bill O'Neill, who's the founder and chairman of Investors Business Daily. The book on the left-hand side, the blue one, was written by Matthew Galgani, who works for IBD. And then the middle book, the red one, is written by Amy Smith, who also works for IBD. If you haven't read any of these books and you're just getting started, I would recommend reading the book on the left, the blue one, Matt Galgani's book. It's a really basic introduction to CanSlim investing. And then the other books get progressively more advanced. And they're not in any particular order here, but the book on the right side, the green book, that's Bill O'Neill's latest book, and that really is the textbook for CanSlim investing. So that covers the basics, it covers intermediate information, and it goes into some advanced topics as well. So if you're just starting, I'd recommend the book on the left. If you are only going to buy one book and you only want to read one book, I would go with the green book, since that really covers the investing strategy in the most complete way. And it really is a book. The Bill O'Neill's book, the green one, it's really a book. You want to read it, and then you want to start applying the investing strategies, and then you want to come back to it and review things, and then tweak your strategy. And really, that constant process of reading this, applying it, you gain a better understanding through applying it, coming back, reviewing it again, refining your strategy. That's really how you can get very successful at CanSlim investing. These are the topics for this month's presentation. The first topic is an IBD Meetup national speaker that was here in Pittsburgh at the end of October. So I have some notes from that. The next is a 7 selling strategies webinar that was hosted by a couple of the IBD portfolio managers. There was the third quarter Leaderboard webinar. If you're not familiar with Leaderboard, it's a premium service offered through investors.com where each day you basically get chart markups and notes about different stocks. And they have stocks they recommend for buying, and then they have ones that they recommend for shorting. And I did subscribe to this for about 6 months, and it is a nice service. And I don't know what the cost is right now. It was about $70 a month when I was subscribing to it. But I'll give some information about the performance of Leaderboard too, and how well it's been performing against the S&P 500. We'll also talk about the Federal Reserve, aka the Fed, and then we'll go through a market analysis. We're just going to look at the NASDAQ, not the S&P 500, and I'll talk about why that's the case. Then a couple slides about earnings season performance as we're on the tail end of earnings season here, and then conclusion. So on October 27th, there was an IBD national speaker. His name was Jack Pacheco. He is one of the meetup coordinators that works for IBD. In fact, he helped set up this meetup group. So he came here, and that presentation was organized by another meetup group. It's not this particular group, but it's called the Pittsburgh Can Slim Meetup. And they're based out of Canonsburg, Pennsylvania. They do meet in person once a month, and it's usually about 10 to 15 people is what I've seen. So if you want to attend an in-person meetup group, that's one group that you can join. And then they do get 2 IBD speakers per year. So you can, even by joining the group, if you don't go to the regular meetups, you could just wait for every 6 months or so when an IBD speaker comes out here. And you can get some discounts on some of the products, like your subscription with IBD or a subscription through investors.com. You can get discounts when they're here. So it's definitely worthwhile to go see that. So these are some of the notes that I took from the presentation, and I thought these were some of the best points to take away from this. So the first point is, in IBD, if you're not familiar with it, IBD has different proprietary rankings for stocks, and they have rankings for things like earnings per share. There's another one called relative price strength. There's a composite rating, and you can see these in the tables in Investors Business Daily. So there's one rating called the accumulation distribution rating, which tells you how much a stock is being accumulated, or basically how much it's being bought or sold by big institutions. And that rating can be A, B, C, D, or E, with A being the best and E being the worst. So the one point that he made was that this accumulation distribution rating is a lagging indicator, and it's based on the previous 3 months of price action in the stock. So it is a useful screening tool to look at this when you're looking at stocks for your watch list or stocks that you're considering to buy. But he did note, you will see weakness in the stock chart before you would see it in the accumulation distribution rating. So it's not really something to be necessarily used as a real-time sell signal, let's say. You really want to follow the chart, which is going to show you any strength or weakness in the stock at that particular moment in time. Next point is, if you buy a stock that breaks out of a sound base and the breakout fails, which has been happening a lot in the past, in 2014 and 2015 with this choppy sideways market, then the stock breaks out again, so it breaks out for a second time, you should consider rebuying that stock. And the reason is that if a stock breaks out and the breakout fails, and then it breaks out again, statistically it's likely, the more times it does that, it's more likely that it's going to work as it continues to try to break out. And the other reason you should consider doing this is because if you've already screened a stock for its fundamentals, and you say, hey, this stock has great fundamentals, it's going on my watch list, you want to keep watching that stock, even if you buy it and have to sell it for a loss, because you've already screened it, And the fundamentals in stocks change slowly. They really change each quarter as earnings are reported. So it's worthwhile to keep that stock on your watch list unless it's starting to show some real significant technical weakness. And that way you don't have to keep constantly adding new stocks to your watch list all the time. If that stock still has good fundamentals and technically it looks okay, consider buying it back the second time. And the key point that he made was that if you buy a stock once and it breaks out and the breakout fails, and then you buy it again as it breaks out a second time, buy a bigger position the second time around, because it's more likely that the second breakout attempt is going to succeed. And this was also a point that was made in a book that's called Trade Like an O'Neill Disciple. And this is written by Gil Morales and Dr. Chris Katcher, who are two former portfolio managers that worked for Bill O'Neill in the 90s. And they do go into some different strategies that aren't necessarily covered by IBD, which I'm going to cover that in a future meetup presentation. But if you're interested in seeing where this is discussed, it's on page 328 of that book, where they said Bill O'Neill will buy a bigger position the second time around if a breakout fails the first time. The next point is Jack Pacheco mentioned that there's 3 questions you can consider asking yourself at times in the market, and he got this from one of the portfolio managers. And the questions are, what is your portfolio doing? What are leading stocks doing? And what is the market doing? So if your portfolio is doing not so well and the market's doing okay, but leading stocks are not doing very well, 2 out of 3 of those are bad, and that is probably an indication that you're not the problem here. Now, on the other hand, if the market was doing well and leading stocks are doing well and your portfolio is lagging, then there's probably something with your strategy that needs to be tweaked. So I thought this was a useful point that he made as well. The next topic, he talked about some advanced buying strategies, and there's actually a home study course that IBD sells that's called Advanced Buying Strategies, where they talk about some early buy points within some of the traditional bases, like a cup with handle, a double bottom, or a flat base. So one point he made was that one early buy point that they talk about is called a sloping trend line. And this is an example here with Baidu, where you can see this is the traditional buy point right here, which is marked as the conventional buy point. And then you can see this trend line that's drawn across the highs of the flat base. And that's marked right here with a trend line for a lower early entry. And the usefulness of this is that instead of waiting for the stock to clear the conventional buy point up here, you could buy this stock when it breaks the trend line, which would be this day right here, instead of having to wait for this day right here when it breaks out of the conventional buy point. So the point that he made in this, if you're using sloping trend lines, whether it's a cup with handle or a double bottom or a flat base, whatever base it is, he said that the more the times that the stock bumps into that trend line, the better. Because you're looking for what he called price rejection, where the stock price comes up and it hits the trend line and then it comes down. And then it hits the trend line and it comes down. So it's hitting resistance against that trend line. And then when it finally does break through that resistance, that is a better sign that the breakout, that it's going to keep going higher after it breaks that trend line. So in this case, you can see we've got the first point up here, we've got the second point here, and then we've got a third point here before it breaks through. So we've seen price rejection in several spots. And usually if you're drawing a sloping trend line, you want to connect at least 3 spots. I've done it with 2, but 3 is even better. The more points, the better, really. All right, the last items from the national speaker. On the NASDAQ chart in IBD, which this is an excerpt here from a portion of IBD. Every day there's a what's the market trend section, and they show chart of the NASDAQ and the S&P 500 and the Dow Jones on one page. So one thing that Jack Pacheco pointed out is that on the NASDAQ chart, on this, which is what we're looking at here, there's a little, what I have boxed here, is called the IBD 6000 accumulation distribution. And what that is out of approximately 6,000 stocks, and I don't know if that's the total number of stocks trading on the open markets. I don't know where that number comes from. But he said that they post here the number of stocks that have an accumulation distribution rating of A, of B, C, D, and E. So this is another way another tool you can use to gauge the overall market health. Because if you start seeing this number of stocks with an A going up over time, that's showing strength in the overall market. If you see that number declining and you see more stocks picking up, you see the numbers increasing on D and E, that indicates more weakness in the market. So this was something I had never seen before, so I just wanted to point that out here. It's something to consider looking at in your daily routine to gauge the overall market health. The next item, which I'm just going to mention briefly, there was a webinar hosted by IBD in November, and I don't have the exact date here, but it was a webinar hosted by two portfolio managers, and their names are Mike Webster and Chuck Harris. And they talked about 7 selling strategies. And in the presentation, they showed stock charts, and they did some live simulations where they walked through day by day certain stocks and assessing whether to sell those or to hold them. And I didn't go into I'm not going into any detail here because you can find that webinar on IBD TV under the How to Invest section, which is shown right here in the red box. So if you are interested in that webinar, it's still available. It's about an hour long. And I was going to go into some of the detail here, but I'm keeping this particular presentation. The goal is an hour or less. So I wasn't able to do that if I was going to cover this webinar in detail. And here are the 7 selling strategies that they covered in this. So if one or two of these is of interest to you, you could go to the webinar and fast forward till you find this. Next topic is the third quarter Leaderboard webinar. And I mentioned earlier that Leaderboard is a premium service through IBD, through investors.com. And their live webinars, which are hosted quarterly, are only available to Leaderboard subscribers. However, this webinar, their last webinar, last couple, are available on IBD TV under the How to Invest section. So it looks like they're making the live webinars available to Leaderboard subscribers, and then they're posting the webinar for everyone, even non-Leaderboard subscribers. So when I saw this, I was sure to watch it because these webinars are really useful. So here's some notes from this webinar, and this is what I've shown here. This screen shot is that's where you can find the webinar on IBD TV, and that's what the icon looks like. So Chris Gessel is the IBD executive editor, and he did most of the talking during the webinar. And he talked about Black Monday, which was August 24th, the day that we had a big decline in the indexes. And it seemed to be kind of a fluke that was caused by computer trading. And they were kind of saying it wasn't driven by people. It was really driven by kind of a computer anomaly. But anyways, he said that they were hoping that Black Monday was actually going to be the start of a new bear market. And he also said that he thinks we need a larger correction before the market can pave the way for big gains. So Black Monday, the crash was it was large. And if you look at the peak price on July 20th to the bottom that was made on August 24th, that was a 21.9% correction. However, it only stayed below that 21.9% correction was very, very short-lived, and it was literally a matter of minutes. Because if you were to look at an intraday chart on August 24th, you'll see early when the market opened, it was way, way low, and it immediately started rebounding. And by the end of the day, it closed. I don't remember the number, but it closed at a very small loss for that day. So IBD generally says that a bear market has to be 20% in depth for a correction to be called a bear market. 20% is the minimum depth. So a question to ask yourself is, do you consider that we just had a bear market in August, considering that we did have a 21.9% correction? I'm saying no. IBD tends to, I don't know they came out and said it, but they implied that they don't consider that a bear market because it was so short-lived, and bear markets are typically over a course of weeks or months, which really gives time to shake out a lot of the holders that are left and really kind of clear the way for a new bull market to come through. So just question to ask yourself, do you consider that we just had a bear market considering that correction in August? And the below table summarizes each bull and bear cycle since 1970. And this goes along that same topic because this was featured on the Investing Show, which is a weekend show that Amy Smith and Matt Galgani, they host that every Saturday. And you can find those videos on IBD TV. And they're usually about 15 to 20 minutes. So they're definitely worthwhile to put on your weekly routine so that you go watch those videos and can gain usually a couple insights each week. So when I saw them post this on September 5th, I was quick to hit print screen because this is a great summary of all the bull bear cycles that the market has had since 1970. And really the key takeaway here is that if you look at the length of all the bull markets, they were generally in the 30-month type of range, if you look at probably about the average. And the longest bull market length we had was from 1982 to 1987, which was 61 months. Well, our current bull market, which has been going since the end of the financial crisis in 2009, we've been going for 65 months, which this was in September, so we're now more like 67 months, 68 months. So this is the longest running bull market since 1970. So does that mean that this bull market's going to end tomorrow? No. And no one really knows how long this bull market's going to run. But you can see that historically we are likely in the late stages of a bull market cycle with a bear market likely to be coming up soon. So that's useful to know because in the early stages of a bull market is when the best gains are made. In later stages of a bull market, the market tends to be more choppy and sideways, which we've seen in 2014 and 2015. And there haven't been a lot of long-running rallies where a lot of money was made in growth stocks. So at the time of the webinar, which was September, they gave some figures on the leaderboard performance versus the S&P 500. So leaderboard, the long positions were at a net 2% loss for the year, and the short positions were up about 16% for the year. So both of these figures exceeded the S&P 500 performance at that time. And the S&P 500, I want to say it was about a 5% loss for the year at the time of that webinar. So despite leaderboard on the long side being at a slight loss for the year, it is outperforming the S&P 500. And especially if you're using their short selling recommendations, then you would have definitely outperformed the S&P 500 pretty significantly. And if you want to learn more about shorting stocks, which I will cover in a future presentation, you can check out some of these resources here. There's a book, a short book, called How to Make Money Selling Stocks Short. And this was written by Bill O'Neill and Gil Morales, who was a former portfolio manager for Bill O'Neill. And it's a short book. It's an easy read. Because unlike buying stocks on the long side, there are fewer chart patterns that IBD will discuss on the short side. So in a way, it can be easier to learn all the chart patterns for shorting than it is for buying stocks long. Another book that talks about short selling is Trade Like an O'Neill Disciple, which I mentioned earlier. There's also a column in IBD that appears to only be published on some Fridays now. I'm not sure why that is the case, but it's called the Short Side column. And last, you can subscribe. If you're a Leaderboard subscriber, they do have their cut list, which is a list of stocks that were recommended for a long position and are now not acting so well, or they're stocks that are recommended for short selling. Some more notes on the Leaderboard webinar. Leaderboard has mostly large caps for long positions at this time, since, like I mentioned earlier, this bull market has been running for a long time, and you'll hear IBD call that long in the tooth. So in later stages of a bull market, institutions become more cautious with deploying their capital, and they tend to invest in safer stocks. So the fact that Leaderboard has a lot of large caps and that some of these big cap stocks are outperforming the smaller cap, newer growth stocks, that is typical action towards the end of a bull market cycle. So it's kind of further evidence that we're in the late stages of a bull market cycle and that a bear market could be right around the corner. No one knows for sure, but it certainly looks that way. So if you want more detail about that, you can go find the investing show from October 31st for that discussion. The next point, although the market was in a new confirmed uptrend at the time of the webinar, which it also is right now, we want to see the 50-day moving average pointing upwards and crossing above the 200-day moving average for the indices, the S&P 500 and the NASDAQ. As of this week, the 200-day moving average and the 40-week moving average are still above the 50-day and the 10-week respectively. So that's not really what you want to see. We really want to see those smaller, the 50-day moving above the 200-day and the 10-week moving above the 40-week. One really interesting point that Chris Gessel mentioned is that they did some new research, and that shows that 80% of stocks that fall 3.3% below the base buy point, 80% of those stocks will fail and reach an 8% loss, or they will form a new consolidation. So historically, IBD has recommended cutting losses at 7 to 8% below your cost basis. So based on this new research, you can actually consider cutting your losses at 4% instead of 7 to 8%. Because if a stock drops 3.3%, it's most likely it's going to keep going down. And if you're going to cut your losses at 7%, which is what I usually do, you're probably going to get triggered out at 7%. So instead of doing that, you could consider saying, hey, if my stock drops 3% or 3.5% or 4%, I'm going to cut my losses there. And then the nice thing about that is that if the stock does rally back up and break out again, you can buy back into it, and you will have taken a lesser loss than you would have taken if you let it go all the way down to a 7 or 8% loss. So that was a nice new piece of research that they provided there. Another point is that at the beginning of a new uptrend, of a new bull market, really, you can give stocks more room as far as cutting your losses. So this new research says kind of implies, hey, you can cut losses at 3 or 4% instead of 7 or 8%. But if we're in the new stages of, if we're in early stage of a new bull market, maybe you want to up that, and 7 or 8% is okay, because stocks are going to more likely have significant gains within the first couple years of a new bull cycle. So in a later stage of a bull market, like right now, this is probably a better time to cut your losses quicker than 7 or 8% because more breakouts are failing. And if you keep buying stocks and taking 7% losses over and over and over, that's like, they call that dying the death of 1,000 cuts. And you really can lose a lot of your principal by doing that. All right, last slide about the webinar was when calculating the base depth for a particular stock. If there is behavior like what we saw on Black Monday, which they call that flash crash type of behavior, you can actually calculate the base depth 2 different ways, and it can give you a better idea of the base's overall health. So there's an example here. And this stock, you can see this down here at the bottom, this big red bar. That was Black Monday. That was August 24th. So if you calculate the depth of this base with that as the low, this base is 38% deep. And that's pretty deep for, I would call this either a cup or just a consolidation. That's a pretty deep correction. But we know that this really only stayed down here. It really only stayed in this very bottom portion of this red bar for a matter of minutes or maybe a couple hours. So you could look at this another way and say, I'm going to ignore that fluke, which was computer-based trading. It was caused by computer-based trading. And I'm going to look at the next low, which is really the next day. And I'm going to use that as the bottom point of this base. And this can be useful. And I just did this for Palo Alto networks because this was it was a fluke occurrence, and we can almost ignore it because that happens very infrequently. And they were saying it wasn't real selling. It was computer-based selling. So if you calculate the depth of this base without that portion of Black Monday, then you get a 20% depth. And that's a healthy correction right there for a stock base. So this base is actually, if you looked at the bottom portion and said it's 38% deep, you might want to turn away from this and not buy it. But you can also look at it without Black Monday and say, well, it actually really was only more like a 20% base, and that's okay. New topic is the Federal Reserve. And just a few basics about the Federal Reserve, also known as the Fed. The Fed is the central bank of the United States, and they control certain interest rates, such as the interest rates that banks can charge each other for lending purposes. So if I'm a bank and I want to borrow money from another bank, if I'm JP Morgan Chase, and I want to borrow money from Citigroup, they can charge me interest on that loan. And the amount of interest they can charge me is controlled by the Fed. So when interest rates increase, which the Fed has been talking about this for the past year, that they're very close to starting to increase interest rates, when they do that, banks can charge more interest, and that means they can make more profits. And this is part of the reason, if you follow the new highs list in IBD lately, banks have been at the top of that list on most trading days. So the market's looking forward, it's future looking, and the market right now is telling us that banks are favorable, and likely one of the reasons is because if interest rates are going to be going up soon, which it appears they will be, then banks will be able to be more profitable. And this chart here at the bottom is over time since the 1950s. It shows you what the percentage is of what's called the federal funds rate. And you can see that right now, since the end of the financial crisis in 2009, ever since then, rates have been at zero. And you can see here that rates have not been zero in the history of this chart. So since 1950s, this is the only time they've ever been zero. So this is causing a lot of uncertainty, and it could be a contributor to why the market has been very indecisive and choppy and sideways over the past 2 years, because we're in a new, we're making history here. No one really knows, once interest rates start rising, what is that going to do to the markets? So again, this is useful to know. A lot of this kind of points to there's a lot of uncertainty in the market right now. So it probably isn't the best time to be buying a ton of stocks and investing a ton of money. Certainly there is some money to be made, and there are some stocks that are making good gains, but it's definitely not an easy time to make big profits. A couple other points related to interest rates. The first one here was from a November 5th IBD Market Wrap video. They mentioned there that gold pays no dividend, so it can become less competitive when interest rates start to rise. So in other words, if interest rates start to rise, then you will tend to see gold underperform. So if we do start seeing interest rates rising and you're looking for something different to invest in, you could consider shorting let's say a gold ETF. On the November 6th income investor column in IBD, they mentioned that utility stocks do not do well when interest rates are rising. And there's a couple reasons mentioned here about why that's the case. So again, this is another play that you could use if the Fed does start raising interest rates. You'll probably will see gold underperforming, and you may see utility stocks underperforming. So again, maybe you want to consider shorting some utility stocks if interest rates do start to rise. And likewise, you could consider buying bank stocks, which are likely to outperform. A couple other points on the Federal Reserve. On November 7th, the Investing Show, Matt Galgani and Amy Smith mentioned that bank stocks are strong lately, as there is a high probability of a Fed rate increase, and banks do benefit from increased interest rates, like I mentioned earlier. And going way back to August 2013, what used to be called the IBD Weekend Radio Show, which is now called the Investing Show, they had a guest on there. His name was Frank Mulvihill, and they interviewed him, and he said that the Fed is far and away the most powerful actor in global finance. So in other words, in his opinion, the Fed is the most influential factor on global markets. And he also has a website where he discusses the Fed influence on the stock market, and that website's called Fed Friday. I've never looked at the website in detail, so I can't recommend it either way, whether it's useful or not. But if you do want to learn more about the Fed influence on the market, this could be a good place to start. Unfortunately, this video, his interview, is no longer on IBD TV because it's so far back. At least I couldn't find it. Next topic is overall market analysis. So I'm only looking at the NASDAQ in these next few slides, and the reason is just that it seems like more of the stocks in IBD are listed on the NASDAQ than on the New York Stock Exchange. And the other reason is that the NASDAQ for a long time now has been outperforming the S&P 500. So I like to compare my investments to the NASDAQ performance, since it's the better performer. And you could outperform the S&P 500, but maybe not outperform the NASDAQ, or maybe not outperform the NASDAQ. So This is a screenshot, just like one I had earlier, of the what's the market trend page in IBD. And every day IBD includes these charts. And they assign an accumulation distribution rating to each of the indices. And if you want to, I would say the quickest gauge of overall market health, you would go to the big picture column in IBD and look at the market pulse and the number of distribution days. And then you would look at these ratings, these accumulation distribution ratings for the major indices. So at the time when I prepared this presentation, the NASDAQ was a C accumulation distribution. So it's not great. It's not an A, which would imply that it's very strong. It's not an E, which would imply that there's heavy distribution. It's right in the middle. So this is kind of consistent with the uncertainty in the market, and we're not getting a clear trend necessarily one way or the other. So as of November 23rd, when I prepared this, the NASDAQ and the S&P had 6 distribution days. And you can see that here in the market pulse, which is posted every day in the big picture column. So this is a moderate distribution day count. If the distribution day count starts going up towards 8 or 10, we're likely to then see IBD put the market back in correction. And if we see this go much above 6, they'll tend to put the market pulse under pressure. So it'll go, instead of confirmed uptrend, it'll likely be an uptrend under pressure. Okay, so now we're going to go into some charts of the NASDAQ, and we're going to start with the monthly chart. So if you look here, going back to in 2008 is when we had the housing and the financial crisis. And you can see that the market made a final bottom right here in early 2009. And that was the start of the current bull market cycle, which I mentioned earlier has been going on for a very long time. And you can see here, you can see how it's just been going up, up, up for a long time. And we really haven't had this type of a long sustained correction, which this was definitely considered a bear market. So again, it kind of adds to the argument that we are due for a bear market. And if you look in the past, if you look at this year alone, you can see each month there's generally been not a lot of movement. And it's been pretty much moving sideways all year. If you look month to month in the first half of the year, the market just wasn't doing a whole lot. And we haven't had a long sustained uptrend for quite some time now. Probably since 2013 we had a nice uptrend. And then 2014 was more sideways, maybe a little uptrend there for a couple months. So it's been a couple of tough years here to make big gains in the market if you're investing using the Cant Slim strategy. So here's the NASDAQ weekly chart, and we can see here we have the Black Monday crash, which was the final bottom for right now, and you can see that it relatively quickly bounced all the way back up. And now we're right back in this same trading range here. We've been in like this box of trading. And I can even draw a box around this. I mean, you can see around here for a long time now, we've been just trading in this box, and not a lot. There hasn't been a lot of movement one way or the other. So again, this is a tough time to make money. Make big money in the market. And this right here is the overall high that we had. We're not quite to there yet, but it seems to be approaching it. So you can see that we had this big correction. We had this pretty big correction here, pretty sharply bounced back up, and now we're right back in this holding pattern of just going sideways and not really doing a whole lot. And here's a daily chart of the NASDAQ. So we're progressively, we started monthly, then we did weekly, now daily, just kind of moving in closer. And again, you can see, in this area here, this is just not really doing a whole lot. Moving, sideways. As soon as it goes up a decent amount, it comes right back, up, down, and then we have this really sharp decline in Black Monday, and then it rallied back up pretty quickly, came back down, rallied up. This was a decent rally here, but this was pretty quick, and it was easy to miss the first couple weeks of this. And now it looks like we're right back in this same range that we've been in for a long time. Right in this range here. We're just trading this box generally, except for this. We had some action outside of that box, but this is going back to February, March. We just haven't seen a lot of gains, so it definitely is. It's been a tough year. So the point is, don't be discouraged. Wait, there will definitely be a new trend at some point, and that's when we can really make some good profits. So it's just a good time now to keep a watch list, and it's okay to buy stocks, but just be cautious in this environment and be patient. And we are gonna eventually, we have to eventually have a trend one way or the other. Last topic is earnings season performance. And just this, I didn't read this in any articles. This is just an observation that I've made recently, is that it seems like more companies are dropping in price on their earnings report than increasing in price after their earnings report. So we'd obviously like to see it the other way around. And I've heard in IBD, I've heard Amy Smith say that at the beginning of a new bull market, earnings season will tend to raise stocks up, even if the earnings report is not great. And lately it seems like we're seeing the opposite, where even if the earnings report is good, it seems like more stocks are dropping in price rather than increasing in price. So I think this is another data point that points to the uncertainty and the lack of strength in the current market. And the below table here, this is just for, if you're curious, I track each earnings season the top 20 stocks in the IBD 50. And I just do the top 20 because it's just tracking all 50 is more time consuming, obviously. So after the stock reports earnings, I keep track of the stock's performance the day after the earnings report. So if it reports in the morning, whatever the stock does that trading day, I record. Or if it reports earnings after the market close, then the next day I'll record the percent change. And this table here summarizes for 2014 and 15 the minimum percent change, in other words, the biggest loss of those 20 stocks, the biggest gain of those 20 stocks, and then I think the most important part here is the average percent change. And you can see that as of right now, when I did this for the third quarter, the average percent change is a small loss. And it's the same as it was last earnings season. And along those lines, this was an article from October 30th in IBD where they talked about the earnings for S&P 500 companies. So the S&P 500 index is an index of 500 companies, generally large cap companies. And they said here that the S&P 500 companies are on track for their first year-over-year earnings decline since 2009, which was the year when we started our new bull market after the financial crisis. And they're citing that this is due to energy woes and a sluggish global economy and weak revenue. So I thought this again was another interesting point about some of the uncertainty and weakness in the overall market. The fact that this is happening for the first time in 6 years it kind of shows again that a lot of companies, it seems like a lot of companies are revising their earnings, their outlook, their future guidance. It seems like more companies are lowering those, and it seems like if you look at the forecast for next year, I don't see a whole lot of companies that are forecasting really big, like triple-digit growth for next year. And so this could be, this could be something that becomes a factor here in the coming months. So that's the end of the presentation. Kept it under 1 hour for everybody. And in conclusion, some future topics. Next month in December, I'm going to post a cheat sheet. It's for reading different chart bases, like a coupled handle, a double bottom, IPO base, flat base, etc. And I'm going to post the Word file and the PDF. So if you want to take the Word file and modify it to suit your own needs, you can do that. I started this based on another cheat sheet that was floating around some of the other meetup groups, but it was only available in PDF form, and it was missing, I think, some key stock chart patterns. So the one I made is a 2-page, so you can print it front and back on 1 page. And I'm actually laminating this, so I have one at home and one at my office because it's really handy for chart reading purposes. And then after that, so the December presentation, I'll go through the cheat sheet so that everyone knows how to use it. And then after that, in January and maybe even February, I'm going to talk about investing routines and daily routines and weekly routines, etc., that you can consider using for your own needs. If anyone has suggestions for future topics or any questions at all, please message me on Meetup. If you just go to the Meetup page for this group and click on find me as the co-organizer, click on my name, and then you can send me a message. I do check those emails. If there's something you want to see in a future video, let me know. If you have a question about something that I covered today, also let me know, and I'll include, if I do get any questions, I'll put a question and answer session in the next presentation so that everyone can benefit from the question and answer. So again, thank you all for joining today. The first presentation for this group. There's going to be a presentation every month moving forward. As the membership grows and we gain more members, if folks are interested in meeting in person each month, that's something that we can discuss. It'll basically be driven by what you guys want to do. If people are interested in meeting, then I don't have a problem organizing that. So it'll basically be, I'll do some survey or something at some point, and we'll figure out if we want to start in-person meetings each month. So again, if you're not a member of the Meetup group, please go back to the very beginning, the first slide. There's a link there to join the Meetup group. And thanks again. I hope everyone had a great Thanksgiving. And we'll talk to you next month. Bye-bye.